The system did not suddenly break. It crossed a line. Once crossed, outcomes narrow, timing compresses, and reversals become mathematically unavailable. That line is reached when debt servicing absorbs the margin of state flexibility. At that point, policy is no longer a tool of choice, but a mechanism of delay. The defining variable is not total debt alone, but the rate at which debt compounds faster than productive output. When interest expense grows independently of economic growth, every additional unit of borrowing produces less stability than the one before it. This is not theory, it is arithmetic. Empires fail, not when they run out of money, but when their obligations grow faster than their capacity to honor them without distortion. At this stage, governments do not default immediately. They extend duration, suppress rates, expand balance sheets, and redefine risk. Each action buys time while reducing optionality. Currency stability becomes subordinate to system continuity. Real purchasing power erodes quietly while nominal values remain intact. This is how collapse advances without triggering alarms. The reason the final phase is measured in months, not decades, is feedback. Rising debt forces intervention. Intervention weakens confidence. Weak confidence raises the cost of capital. Higher costs accelerate the original problem. Once this loop is active, timing becomes predictable, even if precise dates remain uncertain. The term 900 days does not imply prophecy. It describes the historical window between recognition and resolution. In every observed case, once this window opens, the sequence does not reverse. It only proceeds. Every late-stage system follows a repeatable sequence because incentives do not change, only scale. Power accumulates through expansion. Expansion is financed through credit. Credit, when pushed beyond productive return, demands debasement. Debasement masks strain but alters behavior. Once behavior changes, the system begins consuming itself. The framework is mechanical. In the early phase, borrowing increases capacity. Infrastructure, security, and trade expand faster than obligations. Confidence rises because growth validates leverage. In the middle phase, returns flatten. Debt still grows, but productivity does not. To preserve momentum, authorities lower standards, extend maturities, and introduce complexity. This is the point where financial engineering replaces real output. The late phase begins when debt growth becomes reflexive. Borrowing no longer funds expansion, it funds maintenance. Interest is paid with new issuance. Currency stability becomes conditional, not absolute. Policymakers frame this as prudence or flexibility, but structurally it is dependence. The system now requires continuous intervention to remain static. What makes the pattern repeat is not ideology, but constraint. Leaders inherit balance sheets, not blank slates. When faced with insolvency versus debasement, debasement is chosen because it is quieter, it distributes losses across time instead of assigning them immediately. This choice is not malicious. It is rational within the incentive structure of governance. The sequence accelerates because each intervention degrades signal quality. Prices stop reflecting scarcity. Risk is mispriced. Capital flows toward protection, not productivity. As distortion increases, ever larger actions are required to achieve smaller effects. This creates the illusion of control, even as control diminishes. The concept of a script is not metaphorical. It describes a bounded set of responses available once thresholds are crossed. Rate suppression, liquidity facilities, fiscal expansion, regulatory forbearance, and narrative management appear in every case. The order may vary slightly, but the components do not. The final phase is defined by convergence. Fiscal, monetary, and political systems lose independence and move as a single mechanism aimed at preserving continuity. Optionality disappears because alternatives carry immediate costs. At that point, outcomes are no longer shaped by decisions, but by momentum. This framework does not predict events. It defines constraints. Once entered, the path forward narrows until only timing remains variable. The Roman system did not collapse from invasion. It hollowed out from internal arithmetic long before external pressure became decisive. Expansion created obligations that could not be unwound without loss of authority. Armies had to be paid, borders defended, grain imported, and loyalty purchased. These costs were fixed. Revenue was not. Early Rome financed expansion through conquest. New territory produced tribute, slaves, and metals. Growth justified leverage. But once expansion slowed, the model inverted. The empire retained its costs without gaining new income streams. At that moment, Rome entered the same constraint modern systems face: obligations growing faster than productive capacity. The initial response was currency debasement. Silver content in the denarius declined steadily over centuries. This was not accidental policy failure. It was a rational response to fiscal pressure. By reducing metal content while maintaining face value, the state could meet payroll without raising visible taxes. The consequence was delayed, not avoided. As debasement progressed, prices rose unevenly. Soldiers and state contractors were paid first. Merchants demanded higher prices. Fixed-income citizens fell behind. Savings lost purchasing power. The middle strata, artisans, small landholders, traders, absorbed the cost of adjustment. Wealth concentrated upward toward those closest to state distribution. To counter instability, Rome imposed controls. Price edicts attempted to freeze inflation. Capital was restricted. Professions became hereditary to prevent labor flight. These measures did not restore balance. They signaled that voluntary participation was failing. Economic activity shifted from growth to survival. The critical transition occurred when taxation replaced growth as the primary source of revenue. Landowners were squeezed. Smallholders sold to elites who could navigate the system. Rural depopulation followed. Productivity declined further, increasing reliance on debasement. The feedback loop tightened. By the final phase, Rome still appeared powerful. Armies marched. Laws were issued. Coins circulated. But confidence had thinned. Trade networks contracted. Local economies reverted to subsistence. The empire did not end in a single moment. It fragmented as coordination failed. The lesson is not that Rome fell because it printed money, but because debasement became structurally necessary. Once that threshold was crossed, every policy choice reduced future capacity. Collapse was not chosen. It was the cumulative outcome of preserving continuity at the expense of integrity. This pattern, overreach, fiscal strain, debasement, class erosion, control, fragmentation, does not belong to antiquity. It belongs to systems that outgrow their productive base and attempt to compensate with monetary distortion. The collapse of Weimar Germany is often mischaracterized as an emotional or political failure. It was neither. It was a balance sheet collapse driven by constrained options. The state entered the post-war period with obligations it could not service through productive output. Reparations, domestic debt, and social commitments exceeded fiscal capacity. Growth was insufficient. External financing was conditional. The remaining variable was the currency. Initial monetary expansion was defensive. It allowed wages to be paid, benefits maintained, and unrest delayed. In the early phase, this appeared stabilizing. Employment recovered. Markets functioned. The error was not printing money, but assuming that credibility could be preserved while expanding claims faster than real output. As issuance increased, confidence fractured unevenly. Exporters benefited, debtors benefited, fixed income savers did not. Capital moved quickly from currency into goods, property, and foreign assets. This shift increased velocity. Prices did not rise because money existed, but because money was no longer held. That distinction matters. Inflation accelerated only after trust broke. The state responded with escalation, not restraint. More liquidity was required to keep systems operational. Each round reduced purchasing power further, forcing larger interventions for smaller real effects. This is the acceleration phase. Once entered, stabilization attempts deepen the problem because they validate expectations of continued debasement. Social consequences followed structure. The middle class, professionals, retirees, small business owners, was destroyed not by unemployment, but by the erasure of savings. Those with access to credit or real assets consolidated wealth. Inequality widened rapidly, not gradually. Political radicalization was a downstream effect, not the cause. The commonly cited endpoint, hyperinflation, was not the beginning of collapse. It was the visible confirmation that the system had already failed. By the time banknotes were weighed instead of counted, economic coordination was gone. Contracts were meaningless. Planning horizons shrank to days. What makes the Weimar case relevant is not scale, but sequence. The order of events, unsustainable obligations, monetary substitution velocity shock, class destruction, emergency controls, matches every modern fiat breakdown. The tools are more sophisticated today. The constraints are not. Stabilization eventually came through currency reform and external anchoring. This restored trust, but erased prior claims. Losses were not avoided. They were reassigned. The system continued only after discontinuity. The Weimar episode demonstrates a critical principle. Once a state chooses debasement as a primary stabilizer, the end state is not managed normalization. It is a reset forced by exhaustion. The timing varies. The path does not. The current U.S. position can be described without interpretation. Federal debt has moved beyond cyclical expansion and into structural permanence. Total outstanding obligations now exceed the productive growth rate of the economy that services them. This alone does not cause collapse. What matters is interaction. Debt multiplied by interest, constrained by revenue. Interest expense has become the fastest growing line item in the federal budget. Unlike discretionary spending, it cannot be legislated away without default or restructuring. As rates normalize upward from emergency lows, interest compounds independently of policy preference. This converts monetary conditions into a fiscal problem. The state is no longer borrowing to invest or stimulate, but to service prior borrowing. Deficits persist across economic conditions. They expand during downturns and remain elevated during expansions. This signals that baseline spending exceeds baseline revenue even under favorable assumptions. The implication is mechanical. New issuance is required regardless of growth. When borrowing funds both operations and interest, debt becomes self-referential. Money supply expansion has mirrored this trajectory. Balance sheet growth accelerated during crisis response and has not fully reversed. Liquidity injected to stabilize markets remains embedded in asset pricing and fiscal dependency. Withdrawal tightens conditions faster than the real economy can absorb. Continuation weakens currency credibility. This is the constraint set. Foreign demand for U.S. debt has shifted. Maturity preference has shortened. Participation has become more tactical and less structural. This increases rollover sensitivity. When a larger share of debt must be refinanced frequently, rate exposure rises. Small changes in yields translate into large changes in servicing cost. Productive capacity has not kept pace. Output growth is increasingly consumption-driven rather than export-driven. Trade deficits persist, requiring external capital to balance flows. This ties domestic stability to foreign confidence. Confidence, once lost, cannot be compelled through policy. Demographics add pressure. An aging population increases entitlement outlays while reducing labor force growth. This narrows the tax base relative to obligations. Productivity gains would need to exceed historical norms to offset this imbalance. They have not. None of these conditions are controversial. They are published, audited, and observable. The system functions because confidence persists, and markets believe adjustment will occur later rather than now. That belief is the stabilizer. The constraint is that adjustment options are asymmetrical. Austerity is politically limited. Default is institutionally unacceptable. Growth alone cannot close the gap at current scales. This leaves monetary accommodation and financial repression as primary tools. Both preserve continuity while degrading real value. This setup does not imply imminent failure. It defines boundary conditions. When obligations grow faster than capacity, stability becomes a function of perception. Perception can hold longer than fundamentals suggest, but not indefinitely. At this stage, the system is not unstable. It is dependent. Dependency reduces optionality. Reduced optionality increases sensitivity to shock. This is the environment in which late-stage systems operate, not at the edge of collapse, but inside narrowing margins where timing matters more than intent. Stress does not appear first where it is most visible. It appears where leverage is highest and tolerance is lowest. In late-stage systems, those points sit beneath headline data, inside credit markets, balance sheets, and funding channels that only fail when confidence thins. Credit is the first signal. Spreads widen before defaults rise. This matters because spreads measure trust, not loss. When lenders demand more compensation for the same borrower, it indicates uncertainty about future policy and repayment conditions. Refinancing becomes selective. Weak balance sheets are rolled less easily. Strong ones gain advantage. This is how consolidation begins quietly. Banking stress follows structure, not headlines. Asset values may appear stable, while liabilities reprice. Duration mismatches widen when short-term funding costs rise faster than long-term asset yields. Liquidity facilities can mask this temporarily, but they also signal fragility. Banks do not use emergency windows when conditions are healthy. They use them when markets no longer clear smoothly. Yields transmit this stress upward. Rising long-term rates are not inherently dangerous. Rapid repricing is. When yields move faster than fiscal planning cycles, budgets lose predictability. Volatility increases the cost of capital even if absolute levels remain manageable. This volatility forces risk reduction across portfolios, tightening conditions without formal policy action. Labor indicators lag. Employment can remain strong while purchasing power declines. Real wages erode quietly through inflation and benefit reduction. Participation rates soften before unemployment rises. This gives the appearance of resilience while household balance sheets weaken. Consumption holds until credit is exhausted. Asset markets distort next. Nominal prices may stay elevated as currency value shifts. Multiples compress even as indices rise. This divergence confuses observers who equate price with strength. What matters is what assets can command in real terms, not quoted terms. The behavioral split becomes visible at this stage. Institutional capital reduces exposure, shortens duration, and prioritizes liquidity. Retail capital is encouraged to remain invested to support market stability. This divergence is structural, not conspiratorial. Institutions respond to risk models. Households respond to narratives. None of these indicators guarantee collapse. They indicate transition. When multiple stress signals align across credit, banking, yields, labor, and assets, the system enters a phase where interventions produce diminishing returns. The key observation is not failure, but sensitivity. Small shocks now require large responses. Large responses create new imbalances. This is how systems move from stability to fragility without a single defining event. The surface appears calm while structural tolerance declines beneath it. The progression does not unfold as a single break. It advances through pressure points that appear manageable in isolation, but compound over time. The first phase is funding friction. Treasury issuance continues at scale while buyers become more price sensitive. Auctions clear, but with higher concessions. This raises marginal funding costs without triggering alarm. Volatility increases, not because demand disappears, but because it becomes conditional. Within months, policy response becomes reactive rather than strategic. Rate guidance shifts from forward-looking to defensive. Language emphasizes flexibility and data dependence. This signals uncertainty to capital markets. Risk premia widen incrementally. Credit conditions tighten without a formal tightening cycle. Lending standards adjust downward in volume, not terms. The second phase is fiscal compression masked as continuity. Emergency measures are framed as technical adjustments. Spending caps are discussed but not enforced. Revenue assumptions remain optimistic. This gap is bridged through short-duration borrowing. Rollover frequency increases. Sensitivity to rate movement intensifies. Each refinancing cycle becomes a stress test. Midway through the window, a catalyst appears. It may be external, geopolitical, energy, or foreign funding related, or internal, such as a banking or pension liquidity event. The catalyst itself is not decisive. It exposes fragility that already exists. Markets react first, policy follows second. Intervention escalates, liquidity facilities expand. Balance sheets stabilize assets, not valuations. This restores function, but not confidence. The cost is absorbed through currency dilution and future claims. Real yields adjust upward. Savers bear the adjustment quietly. As the timeline advances, distributional effects become visible. Credit availability diverges sharply. Large institutions refinance. Late-stage systems do not fail evenly. They redistribute. The mechanism is structural, not moral. Outcomes are determined by balance sheet position, access to credit, and proximity to policy channels. This sorting accelerates during periods of instability because volatility favors scale and liquidity. The most exposed group is the middle stratum that relies on fixed income, wages, and savings denominated in currency. Inflation erodes purchasing power faster than compensation adjusts. Taxes rise implicitly through bracket creep and explicitly through fees and compliance. Asset ownership is limited, and leverage, if present, is fragile. These households absorb losses gradually, without a single identifiable shock. Small businesses face a parallel squeeze. Input costs rise unpredictably. Credit becomes selective. Refinancing terms worsen. Larger competitors can hedge, negotiate, or absorb margin pressure. Smaller entities cannot. Market share consolidates not through innovation, but through survival. By contrast, entities with scalable assets and access to cheap capital gain advantage. Inflation reduces the real value of liabilities. Asset prices, even when volatile, reprice faster than wages. Those closest to issuance channels can refinance, extend duration, or receive support framed as system stabilization. This is not favoritism, it is mechanics. Systems protect nodes whose failure would propagate risk. Debt becomes a dividing line. Productive, long-duration debt tied to real assets benefits from debasement. Consumer and short-duration debt becomes punitive as rates adjust. The same monetary conditions that compress households expand balance sheets for institutions able to arbitrage them. Wealth consolidation accelerates during uncertainty because distressed assets appear. Liquidity acquires optionality. Those who can deploy capital during dislocation gain ownership at reduced real cost. This pattern appears in every reset phase, regardless of political structure. Importantly, destruction is rarely sudden. It occurs through attrition, savings thin, optional expenses disappear, mobility declines. The system remains functional while participation narrows. This creates the illusion of stability even as access contracts. The outcome is not universal impoverishment, it is stratification. Ownership concentrates, risk is socialized upward, and losses diffuse downward. By the time this is broadly recognized, positions are already set. This is how late-stage systems resolve internal imbalance, not by equalizing outcomes, but by reallocating control. The process is quiet, administrative, and fully consistent with historical precedent. Resets do not arrive as choices, they arrive as acknowledgments. After prolonged intervention, systems reach a point where existing claims exceed what can be honored without impairing future function. At that moment, continuity requires discontinuity. Historically, resets take several forms, often in combination. Currency reform is the most common. Old units are redenominated, replaced, or functionally devalued through inflation and repression. This is not framed as loss. It is framed as modernization, stability, or alignment. The effect is the same. Prior claims are reduced in real terms. Financial repression follows. Capital is guided, sometimes forcibly, into preferred channels. Yields are controlled. Alternatives narrow. Savings are redirected towards state objectives. This stabilizes funding while transferring risk from the public balance sheet to private holders. The system continues, but under constraint. In some cases, explicit restructuring occurs. Obligations are extended, rewritten, or selectively defaulted. Legal continuity is preserved while economic reality changes. Losses are distributed asymmetrically, often to those least able to respond. Confidence resets only after losses are absorbed. What is consistent across history is timing. Resets do not occur at peak distress. They occur after exhaustion, when incremental intervention no longer restores function. At that stage, disruption is no longer feared because it already exists. The reset phase is not collapse. It is reorganization under duress. Institutions survive, but mandates change. Ownership shifts. Growth resumes from a lower real base. Recovery is possible, but prior positions are not restored. This phase is often misinterpreted as renewal without cost. In reality, it is renewal through erasure. The system emerges simplified, less leveraged, and more controlled. Stability returns only after excess claims are removed. History shows that resets are unavoidable once structural imbalance is prolonged. The form varies, the function does not. They resolve what cannot be managed indefinitely. The final phase is not marked by panic. It is marked by normalization. Extraordinary measures become routine. Language shifts from temporary to necessary. What was once unthinkable becomes administrative. At this point, the system does not ask whether it should act, only how quickly. Decisions are framed as technical, not consequential. This framing reduces resistance and accelerates implementation. Stability is preserved procedurally, while substance changes beneath it. The critical misunderstanding is expectation of reversal. Late-stage systems do not revert to prior conditions because the conditions that supported them no longer exist. Productivity, demographics, and trust cannot be restored through policy alone. They require time, restructuring, and lost recognition. The 900-day phase is not a countdown to collapse. It is a window in which outcomes are largely determined. Within it, volatility increases, optionality narrows, and distributional effects harden. By the time clarity arrives, positions are already fixed. History is clear on one point. Systems do not fail from lack of intelligence or effort. They fail from accumulated constraint. And when every available action carries cost, delay becomes the preferred option. Delay, however, compounds imbalance. This is why endings appear sudden. They are not sudden. They are simply the moment when management gives way to resolution. The visible event is only the final adjustment in a process long underway. The purpose of recognizing this phase is not alarm, it is accuracy. Once entered, the sequence does not stop. It completes. The briefing does not end here. It proceeds, as history always has, from imbalance to outcome.